Following the significant downturn on Saturday, October 11, 2025, the Ethereum ETH token demonstrated a notably rapid and robust price recovery compared to many other digital assets. This resilience can be attributed to a confluence of fundamental strengths, specific market dynamics during the crash, and key technical factors. Below is a formal analysis of the primary reasons for Ethereum's swift rebound. The rapid recovery was, first and foremost, underpinned by Ethereum's strong fundamental value, which instills long-term confidence in institutional and retail investors. Unlike purely speculative assets, the selling pressure on ETH was met with significant buy-side demand from participants who view its core utility as undervalued at lower prices. Dominance as the premier smart contract platform, Ethereum remains the undisputed leader for decentralized applications, DApps, including decentralized finance, DeFi, and non-fungible tokens, NFTs. Its vast ecosystem, extensive developer community, and significant network effects created deep economic moat. The crash was not caused by a failure of the Ethereum network itself, therefore, its long-term value proposition remained intact, encouraging investors to buy the dip. Deflationary monetary policy, ultrasound money, the implementation of EIP 1559 and the transition to a proof-of-stake (POS) consensus mechanism, the merge, have fundamentally altered Ethereum's tokenomics. Fee burn mechanism, EIP 1559, during periods of high network congestion, such as the panic selling on October 11, transaction fees, gas fees, spike. A portion of these fees is permanently removed from circulation, burned. Paradoxically, the high activity during the crash accelerated the rate at which the ETH supply was being reduced, providing a real-time, bullish fundamental signal to sophisticated investors. Low issuance from proof-of-stake. The shift to POS drastically reduced new ETH issuance. The combination of low issuance and the active fee burn makes ETH a deflationary asset during periods of high demand. A powerful narrative that attracts capital seeking a store of value. Staking and reduced liquid supply. Under the POS model, a significant portion of the total ETH supply is staked to secure the network. As of October 2025, tens of millions of ETH are locked in staking contracts. This staked ETH is not readily available on the open market to be sold during a panic, which significantly reduces the effective liquid supply and dampens selling pressure. The native yield earned from staking also incentivizes long-term holding over short-term trading. The nature of the crash itself created conditions favorable for a swift recovery for a blue-chip asset like Ethereum. Liquidation-driven price cascade. The market crash was primarily a technical event, triggered by a macroeconomic shock, US-China trade tensions, and massively amplified by a cascade of liquidations in the derivatives market. It was not a crisis of confidence in Ethereum's technology. Once the forced selling from over-leveraged positions was exhausted, the market found a floor, and fundamentally driven buyers were able to absorb the supply at discounted prices. A flight to quality within the crypto asset class. During severe market downturns, capital tends to flee from smaller, more speculative altcoins and consolidate into more established, blue-chip assets. As the second largest and most utilized cryptocurrency, Ethereum is a primary beneficiary of this flight to quality. Investors who sold riskier assets likely rotated some of that capital into BTC and ETH, viewing them as relatively safer havens within the digital asset space. Institutional and whale accumulation. On-chain data analysis from the event indicates that large wallet addresses, whales, and institutional entities were significant net buyers at the lower price levels. These well-capitalized participants often utilize market-wide panics, which are driven by retail fear and forced liquidations, as strategic opportunities to accumulate assets for their long-term portfolios. The price action of Ethereum was also supported by key technical indicators, which provided a clear basis for traders to re-enter the market. Defense of a major support level. The price of ETH found strong support in the critical range of $3.500 - $3.600. This area represented a key psychological level and coincided with previous technical support zones. The strong bounce from this level confirmed it as a zone of high demand, giving technical traders the confidence to open new long positions. Ethereum, proposed in late 2013 and officially launched in July 2015, was created by a group of developers led by Vitalik Buterin. Unlike Bitcoin, which was designed primarily as a peer-to-peer digital currency, Ethereum was envisioned as a general-purpose blockchain platform capable of executing programmable smart contracts. These self-executing contracts allow developers to build decentralized applications, DApps, that operate without intermediaries. The Ethereum whitepaper outlined a vision for a blockchain that goes beyond financial transactions. Vitalik described Ethereum as a world computer, where developers could deploy decentralized logic directly on-chain. This fundamental innovation paved the way for industries such as decentralized finance, DeFi, non-fungible tokens, NFTs, and decentralized autonomous organizations, DAOs. Ethereum's initial funding came from one of the earliest initial coin offerings, ICOs, in 2014, where participants bought Ether, ETH, to fund the project's development. The ICO raised over $18 million, making it one of the largest crowdfunded projects of its time. This successful launch not only demonstrated market demand but also validated the ICO model, which later became a popular fundraising method in the crypto industry. While both Ethereum and Bitcoin rely on blockchain technology, their design philosophies and use cases diverge significantly. Bitcoin is primarily a store of value and digital gold, while Ethereum is more akin to a decentralized computing platform. Key distinctions include smart contracts. Ethereum supports programmable contracts, allowing developers to create complex applications directly on-chain. Ethereum Virtual Machine, EVM, a decentralized computing environment that ensures consistency across all network nodes. Monetary policy. Bitcoin has a capped supply of 21 million BTC, whereas Ethereum initially had no fixed supply. Post-2021 upgrades, EIP 1559. Ethereum adopted a fee-burning mechanism, making ETH partially deflationary. Consensus mechanism. Ethereum transitioned from proof-of-work, POW, to proof-of-stake, POS, in September 2022, drastically reducing energy consumption by over 99%. This adaptability has allowed Ethereum to remain highly relevant, evolving alongside the needs of the blockchain ecosystem. Since its launch, Ethereum has undergone numerous critical milestones, each shaping its trajectory. 2016 The DAO hack, one of the earliest decentralized organizations. The DAO raised $150 million in ETH but was exploited due to a vulnerability in its smart contract. This led to a controversial hard fork, splitting Ethereum into Ethereum, ETH, and Ethereum Classic, etc. 2017 ICO boom. Hundreds of projects launched ICOs on Ethereum, solidifying it as the go-to platform for token creation. 2020 DeFi summer. Protocols like Uniswap, Aave, and Compound ignited explosive growth in decentralized finance, with billions of dollars locked on Ethereum. 2021 NFT explosion. NFTs such as CryptoPunks and Bored Ape Yacht Club brought mainstream attention, making Ethereum the dominant NFT marketplace. 2022 The merge. Ethereum successfully transitioned to POS, marking one of the most significant upgrades in blockchain history. 2023 to 2025 scalability efforts. The introduction of Layer 2 rollups and upcoming danksharding represent Ethereum's roadmap to scale for mass adoption. Ether, the native token of Ethereum, serves multiple purposes. Transaction fees, gas, ETH is required to pay for executing transactions and deploying smart contracts. Staking and network security. In POS, validators must stake ETH to participate in block validation and secure the network. Store of value and collateral. ETH is widely used as collateral in DeFi protocols and is increasingly viewed as a digital asset akin to Bitcoin. Deflationary pressure. Post-EIP 1559. A portion of transaction fees is burned, reducing supply and potentially increasing value over time. ETH's dual role as both a utility token and an investment asset strengthens its market position. Unlike many cryptocurrencies, ETH has real economic demand due to its integral role in running applications and protocols on Ethereum. Ethereum is at the heart of Web3, the decentralized vision of the Internet. In Web3, users retain ownership of their data, interact with decentralized services, and participate in governance without relying on centralized platforms. Ethereum enables this paradigm through DeFi protocols offering banking services without intermediaries, NFT ecosystems enabling ownership of digital art and assets, DAOs allowing collective governance of projects and communities. The ecosystem has expanded far beyond Ethereum Layer 1, with Layer 2 scaling solutions such as Arbitrum, Optimism, ZKSYNC, and Polygon playing crucial roles in making Web3 applications more efficient and affordable. Despite its dominance, Ethereum faces several challenges. Scalability. High gas fees and limited throughput remain pain points, especially during peak demand. Competition. Rival blockchains like Solana, Avalanche, and Sway offer faster and cheaper alternatives. Complexity. Developing secure smart contracts requires significant expertise. Vulnerabilities often lead to exploits and hacks. Regulatory uncertainty. Governments worldwide are still debating how to classify and regulate ETH. These challenges highlight the need for Ethereum to continuously evolve, ensuring it maintains its leadership role in the blockchain space. Ethereum has evolved from a novel idea into a multi-trillion-dollar ecosystem that underpins decentralized finance, digital art, and next-generation internet applications. Its adaptability, driven by a strong developer community and continuous upgrades, has secured its position as the leading smart contract platform. The next chapters will explore Ethereum's technological upgrades, scalability solutions, ecosystem growth, and future price outlook, providing a comprehensive view of its trajectory toward 2030 and beyond. At the heart of Ethereum lies the Ethereum Virtual Machine, EVM, a decentralized computing engine that ensures all smart contracts execute in a consistent and deterministic manner across the network. The EVM acts like a universal runtime environment, meaning developers can write code in high-level languages such as Solidity or Viper, which is then compiled down into bytecode that the EVM can process. Key properties of the EVM include deterministic execution. Every node in the network processes the same instructions and arrives at the same result, ensuring global consensus. Turing completeness. Unlike Bitcoin's limited scripting language, the EVM can run complex logic, making it capable of hosting decentralized applications with virtually limitless functionality. Gas metering. Each operation executed on the EVM requires gas, which prevents infinite loops and denial of service attacks. Gas fees also incentivize miners, now validators, to prioritize transactions. Because of the EVM's versatility, Ethereum has become the default standard for blockchain development, leading to the ERC-20 token standard for fungible tokens and ERC-721 for non-fungible tokens. Ethereum initially launched using the same consensus mechanism as Bitcoin, proof of work, POW. In POW, miners competed to solve cryptographic puzzles, securing the network in exchange for block rewards. While effective, POW was heavily criticized for its energy consumption. After years of research and phased upgrades, Ethereum transitioned to proof of stake, POS, in September 2022. An event famously known as the merge. In this system, validators replace miners. To participate, a validator must stake at least 32 ETH as collateral. Validators are randomly selected to propose and validate new blocks. Misbehavior, such as attempting to double-sign blocks, results in penalties, known as slashing. Energy efficiency. Reduced energy consumption by over 99%. Security through staking. Attacking the network requires controlling massive amounts of ETH, making it prohibitively expensive. Decentralization incentives. Staking pools and liquid staking solutions, e.g. Lido, Rocket Pool allow smaller holders to participate. The merge was a historic milestone not only for Ethereum but also for the broader crypto industry, proving that a live blockchain with hundreds of billions in assets could successfully upgrade consensus mechanisms without disruption. While POS solved Ethereum's environmental concerns, it did not immediately address scalability. Ethereum's Layer 1, the base chain, still handles roughly 15 to 30 transactions per second, TPS, which is far below what is needed for mainstream adoption. During periods of congestion, users often face gas fees exceeding $50 or even $100 per transaction, making small transfers or dApp interactions impractical. To solve this, Ethereum's roadmap emphasizes two complementary solutions: Layer 2 scaling, rollups and sidechains. Sharding, planned for future upgrades. Layer2, L2, solutions process transactions off-chain, or in batches, while still relying on Ethereum Layer 1 for security. The most prominent approaches include optimistic rollups, e.g. Arbitrum, Optimism. These solutions bundle thousands of transactions into one batch posted to Ethereum. Disputes can be challenged using fraud proofs. Optimistic rollups drastically lower transaction costs, often to under $1. Zero-knowledge rollups, ZK rollups, e.g., ZKSYNC, Starknet. ZK rollups generate cryptographic proofs to verify the correctness of off-chain transactions. They are considered more secure and faster for withdrawals than optimistic rollups, though more complex to implement. Sidechains, e.g. Polygon POS chain. Independent blockchains connected to Ethereum through bridges. While they provide cheap and fast transactions, they do not inherit the same level of Ethereum's security as rollups. As of 2024, Layer 2 adoption has skyrocketed, with billions of dollars in assets migrating to Arbitrum, Optimism, and ZKSYNC. Many DeFi protocols now deploy directly on these networks to provide cheaper and faster user experiences. Beyond Layer2, Ethereum plans to implement sharding, splitting the blockchain into multiple smaller shards that can process transactions in parallel. However, due to the complexity of implementation, Ethereum has adjusted its roadmap toward danksharding, an advanced version optimized for rollups. Danksharding focuses on data availability sampling, making it easier for rollups to publish data to Ethereum securely. This approach leverages proto-danksharding, EIP 4844, a temporary solution introducing blob-carrying transactions, which significantly reduce the cost of posting rollup data to Ethereum. With these advancements, Ethereum is expected to scale to tens of thousands of TPS, making it competitive with centralized payment processors like Visa while retaining decentralization. Ethereum's development roadmap is divided into several key phases, famously nicknamed by Vitalik Buterin. The merge, completed in 2022, transitioned to proof of stake. The surge, ongoing 2023 to 2025, focus on scaling through rollups and proto-danksharding. The scourge, improvements in decentralization and censorship resistance. The verge, introduction of Verkle trees to optimize storage and improve proof efficiency. The purge, reducing historical data load for nodes, making the network easier to run. The splurge, miscellaneous upgrades and fine-tuning of the network. Each stage represents Ethereum's commitment to long-term sustainability, scalability, and decentralization, ensuring it can support the global Web3 ecosystem. Ethereum's open, permissionless nature makes it both powerful and vulnerable. The most common security risks include smart contract exploits. Errors in code, e.g. re-entrancy bugs, can lead to devastating losses, as seen in the DAO hack and multiple DeFi protocol exploits. Bridge attacks. Cross-chain bridges have become major attack vectors, with billions stolen due to weak security. Validator attacks. Though rare, coordinated attacks on the POS validator set could threaten consensus. To mitigate these risks, Ethereum relies on formal verification and audits of smart contracts, incentive mechanisms such as slashing, a large and active developer community rapidly responding to vulnerabilities. Ethereum is not alone in the race for blockchain dominance. Competitors like Solana, Avalanche, Cardano, and Sway aim to provide faster, cheaper, and more scalable alternatives. However, Ethereum maintains significant advantages. Network effects. Ethereum has the largest developer community and dApp ecosystem. Liquidity and capital. Most DeFi liquidity resides on Ethereum or its L2s. Security and credibility. Ethereum's long track record and POS transition enhance its credibility with institutions. Nonetheless, competition remains fierce, and Ethereum must continue innovating to retain its dominance. Post-merge, staking has become central to Ethereum's security and economy. Over 30 million ETH, as of mid-2025, is staked, representing nearly 25% of the total supply. This creates strong supply-side pressure, as staked ETH is locked and cannot be sold immediately. Additionally, liquid staking derivatives, LSDs, such as STETH, Lido, RETH, Rocket Pool, and CBETH, Coinbase, have created a new DeFi sub-sector. These tokens allow ETH holders to stake while retaining liquidity, providing yield opportunities across DeFi. The rise of LSDs highlights Ethereum's evolving role not only as a smart contract platform but also as a yield-bearing financial asset. Ethereum's technological backbone, the EVM, proof-of-stake consensus, and scalability roadmap, positions it as the premier platform for decentralized innovation. While challenges persist, the combination of Layer 2 adoption, danksharding, and staking economics ensures Ethereum will remain central to the Web3 ecosystem. The next chapter will explore Ethereum's ecosystem growth, including DeFi, NFTs, DAOs, and enterprise adoption, analyzing how these use cases strengthen ETH's long-term value proposition. Decentralized finance, commonly referred to as DeFi, has been one of the most transformative innovations built on Ethereum. DeFi replicates traditional financial services, such as lending, borrowing, trading, and insurance, but without intermediaries like banks or brokers. Instead, DeFi relies on smart contracts that execute automatically on Ethereum's blockchain. Uniswap, a decentralized exchange, DEX, that pioneered the automated market maker, AMM, model. Instead of order books, liquidity is provided by users who earn fees for supplying capital. Aave and Compound, protocols enabling permissionless lending and borrowing. Users can deposit assets to earn interest or borrow against collateral. MakerDAO, the creator of DAI, a decentralized stablecoin pegged to the US dollar, backed by on-chain collateral. Curve Finance, a DEX optimized for stablecoin trading, ensuring low slippage and high capital efficiency. These protocols, among many others, have created a parallel financial system with billions of dollars in total value locked, TVL. Transparency. All transactions are verifiable on-chain. Accessibility. Anyone with internet access and a wallet can participate. Composability. Protocols are money Legos that can integrate with one another seamlessly. Despite its innovation, DeFi carries risks. Smart contract bugs. Exploits can drain funds from protocols. Impermanent loss. Liquidity providers may lose relative value compared to holding assets. Regulatory uncertainty. Governments are still determining how to oversee decentralized platforms. Ethereum remains the hub of DeFi because of its network effects, liquidity, and security, even as competing chains like Solana and Avalanche launched DeFi ecosystems. The majority of institutional and developer attention still gravitates toward Ethereum. Non-fungible tokens, NFTs, became a cultural and financial phenomenon in 2021-2022. Largely built on Ethereum, unlike fungible tokens, such as ETH or USDC. NFTs represent unique digital assets, with ownership verified on-chain. Digital art. Projects like CryptoPunks and Bored Ape Yacht Club established NFTs as status symbols. Gaming assets. Games like Axie Infinity and Illuvium use NFTs to represent in-game characters and items. Music and media. Artists release limited edition albums, tickets, and content as NFTs, creating new revenue models. Real-world assets, tokenized real estate, luxury goods, and intellectual property are emerging use cases. Ethereum's ERC-721 and ERC-1155 standards set the foundation for NFTs. While competitors like Solana and Polygon also host NFTs, Ethereum remains the blue-chip blockchain due to its reputation and liquidity. NFT marketplaces such as OpenSea, Blur, and LooksRare are built primarily on Ethereum or its Layer 2 solutions, cementing Ethereum as the leader in digital ownership. DAOs are another cornerstone of the Ethereum ecosystem. A DAO is a decentralized entity governed by smart contracts and token holders, rather than centralized leadership. Uniswap DAO. Token holders govern protocol upgrades and fee structures. MakerDAO. Decentralized governance over the DAI stablecoin. Pleaser DAO. A collective that pools funds to purchase and manage NFTs and cultural assets. Decentralized governance. Power is distributed among token holders. Transparency. All decisions and funds are traceable on-chain. Global participation. Anyone can join governance without geographic limitations. DAOs have become experiments in collective decision-making and resource allocation. While governance challenges remain, e.g. token concentration among whales, DAOs represent a new model for organizing communities and projects. Beyond consumer-facing innovations, Ethereum has also attracted significant enterprise interest. The Enterprise Ethereum Alliance brings together companies like Microsoft, J.P. Morgan, and Consensus to develop enterprise-grade blockchain solutions. These efforts focus on private or permissioned versions of Ethereum tailored for business needs. J.P. Morgan developed Quorum, a permissioned version of Ethereum designed for enterprise use cases such as interbank settlements. While Quorum has since been acquired by Consensus, its adoption demonstrates Ethereum's versatility in enterprise contexts. Ethereum enables the tokenization of traditional assets such as stocks, bonds, and real estate. This could unlock trillions of dollars in liquidity by making traditionally illiquid assets tradable 24/7 on blockchain networks. While most CBDCs are not being built directly on Ethereum, Ethereum's infrastructure and developer expertise are influencing central bank experiments globally. Some governments have tested Ethereum-based platforms for pilot projects. Ethereum sits at the center of the Web3 stack, which includes infrastructure, Ethereum Layer 1 and Layer 2 networks, middleware, protocols like the Graph for data indexing and Chainlink for decentralized oracles, applications, DeFi apps, NFT marketplaces, gaming platforms, and DAOs, user interfaces, wallets like MetaMask, hardware wallets, and Web3 browsers. This layered structure demonstrates Ethereum's role as a foundational technology powering the decentralized internet. While the ecosystem is thriving, several challenges remain. High gas fees. Even with Layer 2 adoption, some users are priced out during peak demand. Security risks. Hacks and exploits remain a persistent issue. Regulatory pressure. NFT royalties, DeFi compliance, and DAO legal structures are under scrutiny. User experience. Wallets and DApps remain too complex for mainstream users. These barriers highlight the importance of continued innovation in scalability, security, and usability. Looking ahead, Ethereum's ecosystem will likely evolve in the following ways. DeFi 2.0. More sustainable yield models and integration with real-world assets. NFT utility. NFTs will move beyond collectibles to include identity, memberships, and metaverse integration. DAO maturity. DAOs will experiment with legal recognition and hybrid governance models. Enterprise adoption. More Fortune 500 companies will tokenize assets and adopt Ethereum-based solutions. Cross-chain interoperability. Ethereum will interact seamlessly with other blockchains, powered by secure bridging technologies. The Ethereum ecosystem has grown far beyond its original vision as a programmable blockchain. With thriving sectors like DeFi, NFTs, DAOs, and enterprise adoption, Ethereum is shaping a multi-trillion-dollar digital economy. Its position as the backbone of Web3 ensures that ETH is not just a speculative asset but a critical resource for global digital infrastructure. The ecosystem's diversity and resilience are key reasons why Ethereum remains the dominant smart contract platform. Since its launch in 2015, Ethereum's price history has been marked by dramatic cycles of boom and bust, reflecting broader trends in the cryptocurrency market. 2015-2016, ETH was initially valued at under $1. Early adopters and developers accumulated the token during its formative years. 2017 bull run, fueled by the ICO boom. ETH surged to nearly $1.400, capturing mainstream attention. 2018 to 2019 bear market, following the collapse of the ICO bubble. ETH dropped below $100, testing investor confidence. 2020-2021 DeFi and NFT surge. Ethereum's role as the foundation for DeFi and NFTs drove ETH to new highs, reaching over $4.800 in late 2021. 2022-2023 transition to proof of stake. The merge created renewed optimism, with ETH stabilizing in the $1.200–$2 range before recovery. 2024-2025, with Layer 2 adoption, institutional interest, and staking growth, ETH regained momentum, trading in the $3–$4 range by mid-2025. This cyclical behavior demonstrates Ethereum's resilience, despite volatility. Each bear market has been followed by a stronger recovery, supported by real ecosystem growth. Ethereum's future price performance between 2025 and 2030 will be influenced by several fundamental drivers. With over 30 million ETH staked, a significant portion of supply is effectively locked, reducing circulating liquidity. Coupled with EIP 1559 fee burns, Ethereum has transitioned into a potentially deflationary asset. Lower supply combined with strong demand may put upward pressure on ETH's price over time. Ethereum is increasingly being adopted by institutional players. Hedge funds and asset managers treat ETH as a core allocation alongside Bitcoin. Exchange-traded funds, ETFs, based on ETH futures and spot ETH could attract billions in capital. Enterprises are exploring Ethereum-based solutions for tokenization and settlement. Institutional adoption is likely to provide long-term stability and expand ETH's investor base beyond retail. As rollups and proto-danksharding reduce transaction costs, user adoption will grow. If Ethereum can achieve tens of thousands of TPS, it could host mass market applications, ranging from gaming to global payments, further boosting demand for ETH. Ethereum faces strong competition from Solana, Avalanche, Cardano, and newer blockchains optimized for speed and scalability. However, Ethereum's network effects, security, and liquidity dominance give it a defensive moat. Future market share battles will influence ETH's valuation. Global interest rates, inflation, and regulations around crypto assets will significantly affect ETH's trajectory. Regulatory clarity in major markets like the US and Europe could unlock institutional capital, while restrictive policies could slow growth. Given the uncertainty in both global markets and the crypto industry, it is helpful to explore three possible price scenarios. Bullish scenario, ETH at $10–$15. Ethereum achieves mass adoption of Layer 2 solutions. Institutional adoption accelerates, with multiple ETH ETFs launched worldwide. DeFi, NFTs, and DAOs reach mainstream penetration. ETH's deflationary supply dynamics enhance scarcity. Base case scenario, ETH at $5–$8. Ethereum maintains dominance in DeFi and NFTs but faces stronger competition. Institutional adoption grows gradually. Scaling solutions make Ethereum more user-friendly but not yet perfect. ETH experiences steady growth tied to ecosystem expansion. Bearish scenario, ETH at $2–$3.500. Regulatory crackdowns stifle innovation. Competing blockchains capture significant market share. Ethereum's scaling roadmap experiences delays or technical challenges. Global economic downturn reduces appetite for risk assets. While exact predictions are difficult, most analysts agree that Ethereum will remain one of the top 2 or 3 blockchain assets by market capitalization. Ethereum as digital oil. Unlike Bitcoin, often referred to as digital gold, Ethereum is increasingly described as digital oil because ETH fuels the decentralized economy. Just as oil powers industrial economies, ETH powers smart contracts, decentralized apps, and Web3 transactions. This analogy highlights ETH's utility value beyond speculation. As long as developers continue to build on Ethereum, ETH will remain a core resource with real demand. Long-term risks to Ethereum's price. Despite its strengths, Ethereum faces several risks that could impact its price. Centralization of staking. If a few staking pools dominate, Ethereum's decentralization may be questioned. Security breaches. Major exploits or failures could undermine trust. Technological disruption. A new blockchain with superior technology could erode Ethereum's market share. Geopolitical and regulatory risks, bans, restrictions, or taxation policies could reduce global adoption. These risks emphasize the importance of diversification for investors and continuous innovation by Ethereum's developer community. Ethereum's future between 2025 and 2030 will be shaped by its scalability upgrades, ecosystem growth, institutional adoption, and macroeconomic conditions. While short-term volatility will persist, Ethereum's fundamental value as the backbone of Web3 positions it as a long-term growth asset. Under bullish conditions, ETH could surpass $10 by 2030. Even in bear or bearish scenarios, Ethereum will likely remain one of the most influential and valuable blockchains in existence. Across the past 4 chapters, we have explored Ethereum's history, technology, scalability roadmap, ecosystem growth, and price outlook. From its origins as a visionary project to its role as the backbone of decentralized finance, NFTs, and Web3, Ethereum has proven its resilience and adaptability. Whether viewed as digital oil, a programmable money layer, or a global decentralized computer, Ethereum continues to shape the future of finance, technology, and digital ownership. Its path to 2030 will be defined not only by price but by the real-world adoption of the decentralized internet it powers.